Welcome to an options deep dive where we go into a detailed discussion about trading options in some way or form. Now, in today's video, I'm going to dive deep and give you a little insight onto how your position makes or loses you money, because I will tell you that most people, when they're evaluating their options position, they're doing it the wrong way. Now, if you want to check out some other great things online and continue your options trading education, definitely check out our website at tradersfly.com. There's a lot of great stuff there to learn, free videos and even mini courses that you could download absolutely for free. So check out the freebies and other things on the website. Anyways, let's get started into our options deep dive. And what I want to do is take a look at how most people evaluate a position and the approach they take, because what I find is after doing a ton of different coaching sessions and working one-on-one with people, really people evaluate a position at a very basic level when it comes to option trading. And you may think, hey, I've been doing it this way for a while and it's been working okay. But the thing is that when it's working fine, it's okay. But when it's not working is really where the problems start to lie. And it's because you're not seeing the bigger picture. So I will say that, okay, most people, what they do when it comes to trading the option is that they only look at the delta or the price. So when we go in and we'll take it from just a simple single option contract. So I will go in and do a standard about a 35-day option on, let's go to Microsoft, okay? Actually, I already have Microsoft. Yeah, that's okay, Microsoft. We'll go to Microsoft here, and we'll go in and buy the 350 call right here, because most people are doing singles. So I'm going to go ahead and do a single call contract, and I will hide all the positions for the time being. And now we have a single call contract. So there we go. We've got a single call contract in this position. And you might say, you know what? I trade bigger or I trade larger. Okay, so we're going to go to 10 contracts and we'll start there. So that's a $10,000 position on single calls that you might be doing. And you might be doing leaps, and we'll talk about that in a bit. So most people, what they're doing is they're evaluating on price, and they say, you know what? Hey, if the stock goes up, I make money. That's a good basic approach when you think about it, because it's true. You know, if the stock does go up, you do make money because you do have a positive delta. So if we look at just the delta side right here, that's like having 482 shares right there in your pocket. So when you go in and you buy something like this, you're looking for a positive upside move because you've got a delta. But here we're focused strictly on price. And this could be a little bit of a problem because you're not taking into account everything else. Because it's the Greeks, all of these things, that make you or lose you money. Okay, so from moving on the delta side, let's look at delta in how this works. So if we go in and add a couple of dollars, so if we go and add $2, right now we're starting down with $75, but if we move $2 higher, remember the delta is how much you make for every dollar move up, at least in this case. So about $500 is what we've got. So if we move up $2, we should be up about $1,000, a little bit less than that, but we're not going to be super precise right this second. But here, what we've got is about $920. So if we moved up $2, here I set the offset, $2, our delta did change a little bit. We're up about $1,000. So this is all fine and dandy when it comes to, hey, thinking about the price move, because that's what most people are thinking about. Okay, so as price goes up, we're making money. Now, the problem with this is, though, we have to take now into account the time decay. And some people will look at the time decay or the theta. So I will say people that are looking at it this way, in this case, this is even better, a deeper form of understanding your position. Now, if you're doing a one-day option, you might say, hey, I'm doing a single day or 0 day or 5 day. You might say, I don't need to look at the theta. And you could say, yeah, that may be true. But the thing is time is still decaying. This is all part of your position. Maybe it's not as relevant for you, but it's still a part of that position. So as you start spreading money out, if you're only doing 0 DTE, you're probably not trading a large account. And if you are trading a large account with 0 DTE, then you have a high degree of concentration of risk in short duration trading. For example, you wouldn't trade $3 million in a 0 DTE account, at least not the everyday person. There are exceptions, and I'm sure there are people that do it. But what you'll want to do normally is spread money and capital in different zones, different positions, different expirations all over the place. So when we look at something like this, what we've got going on here is we've got $1,000 plus, but if that position took a little bit of time to get there to move $2, what's happening is we're losing $145, $146, $147 per day on that position. So if this took a few days to get here, let's just move the date and watch this profit and loss right now. Okay, we take a couple days forward, all of a sudden we're down to 423. Now we're not up $1,000. Okay, we're now down to 423. We cut our position or profits in about half. And the initial position, if the stock didn't even move, we're down by about $500. So what's happening now is we're taking two variables into account on our position instead of just looking at one variable, price. Now we're looking at price and time. And what happens here is this is now a deeper form. But if we look at it at a third level, now we have to look at the Vega, and very few people actually look at the Vega and how it plays a role. And I will share with you something here, because when you look at these Greeks, you've got a delta, gamma, theta, and Vega. Gamma is the relationship to delta, how fast that moves. But when you look at these Greeks, look at your biggest Greeks. These are your risks, but they're your money makers. But your biggest risk is delta, right? It's price, and that's why most people focus on it. However, what's your next biggest Greek? Your next biggest Greek is actually Vega, and very few people take this into account. So when you actually look at this position, what happens with volatility as a stock goes up? So as the stock heads higher, what actually happens to volatility is volatility goes down, right? As stock prices head higher, things get calmer, which kind of means volatility goes down. So if we open up the gear icon over here and we go to a volatility adjustment, watch what happens as volatility goes down. So as volatility goes down, we start moving it down. Look at this. We actually start losing money. So if we go 1 full point, we lost how much? About $400. So let's go back to a normal level. Here we have a Vega 412, a profit of 419. And if we actually switch to a -1%, we lose about that $400. So think about that. You've bought an option where you have a big Vega that's positive. You're thinking you're bullish on the position, but what's happening is you're dragging yourself down on the Theta and the Vega. So your risks on this position moving up slowly, you actually have $150 of risk here and $400 of risk here. That's like having $550, $560 of risk as that stock is slowly grinding up, and you're only making $500 if it goes up $1. So you really need it to move. When you're buying a single, you need it to move, and you need to move quick. Now, I'm not saying that single options don't work. What I'm trying to show you here is that when we dive deep into the information here, we have to take all variables into account. We can't just look at just price, because we do have a big Vega component here, okay? And if you're into trading, let's say, leaps or longer term, let's go even further, and let's reset some of these positions. What I want to point out even further, for those of you guys that are doing longer term stuff, you've got a Vega that's almost twice the delta. So now you actually have a bigger component. So as that stock heads higher, okay, and it continues to head higher, yes, maybe your theta is a little different, but as volatility compresses, you actually are losing more and more money from that. So you're losing twice as much as what we showed earlier. So the point here is that you got to look at all three pieces when you're looking at trading options. You can't just look at one piece. You got to look at the delta. You got to look at the theta and the Vega. If you're looking at just the delta, you're missing out on theta then. And then if you're looking at delta and theta, make sure you then start looking at the Vega as well. These are very critical and important. These are kind of things that are making you money or losing you money. And it's what you want to watch. So as you start diving deep into a position, this is what you're looking at. Now, when we actually look at other positions, you might say, well, I don't need to worry about those things because I trade different spreads. And that may be the case, but at least then you understand that. So if you're trading like a vertical spread, let's say something like an at the money vertical, the Vega and Theta component is actually non-existent almost. You are really dealing with the delta, but you do have time decay that does eventually catch up to you, depending on where your option lands. But even with 20 contracts here and a bigger delta, you don't really have that big of a Theta problem or a Vega problem. So that's why verticals are a little bit different and make a little sense. But at least now you're understanding, hey, what's my Theta? What's my Vega? But if you're just dealing with regular options and you don't know your Theta, your Vega, and how they work and operate, it's time to start. So anyways, I hope that helps and gives you a little bit of insight into diving deep into looking at these variables, because these are the ones that make you money or lose you money. And if you're kind of new to trading options, I highly encourage you to check out tradingwebinars.co. This is kind of our free webinar area where you can just go ahead and download and watch some webinars on trading options to go ahead and just learn more about option trading. So check that out. You can also visit tradersfly.com, our primary website, where we have a lot of free blogs and videos. And of course, book a one-on-one session if you want to chat and connect further. Anyways, thanks for watching. Hope you enjoy the rest of your day ahead, and I will see you in the next video. Take care.